So welcome to those who are joining us online. Today we're going to talk about Division 296, and you're joined by myself, David Maddock, and Luke Sapanic. So what we're going to cover off on today, Division 296, what it means for your superannuation. Today we're going to give you an overview of the impact of Division 296, some of the things to think about. There's going to be quite a few things to think about for those people that are going to be impacted. So this will at least give you an idea of what you need to start thinking about in preparation for this tax coming in from the next financial year. As always, any apt event in this type of forum is a general advice information only. So you do need to seek your own personal advice and tax advice in relation to your own personal needs. And a couple of things just to be aware of, this is getting recorded. So you will get a copy of this recording to watch at a later date, should you wish to. And also you'll find there should be a chat function in your Zoom webinar that we're having today. If there's any questions that you have, you can put them into that chat group. We have allocated some time at the end to have some chat about, in general, about Division 296. We won't talk about any specific cases if it's specific to your situation for obviously privacy reasons, but we can talk in general terms if there are any questions that you do have. So just as introduction, I'm David Maddock, Senior Financial Advisor at Apt Wealth Partners. I've been in the industry for over 20 years and been with Apt over 11 years now, and specialise in self-managed super funds, and that Division 296 does have an impact on self-managed super funds, but also just retirement in general. And this isn't just a self-managed super fund tax, mind you, it is a tax that will impact anyone that has a large super balance. And my colleague here that I deal a lot with in the Geelong office, Patrick Rowan and Associates Director Luke Sapanic, again, very experienced SMSF tax accountant over 20 years and director at Patrick Rowan's. And we work closely, in particular, with a lot of clients in the SMSF space. So he'll talk about a lot of the tax implications, being a tax professional. I'll talk about more some of the strategic things to consider on with this introduction of this tax. So what is Division 296? Well, this is over to yourself, Luke. You can explain to those listening the tax and what it actually means.
No worries. Thanks for that introduction, David. All right, Div 296 tax. Well, it's a new tax, and it's really after a sort of long history, which was first mentioned back in February 2023 via a media release by the Treasurer and the Assistant Treasurer. And after some changes and tweaks along the way, finally it's been given royal assent. So basically, what this tax is, if you've got a total super balance above $3 million, there's going to be an extra 15% tax on the earnings above the $3 million. And with this tweaking along the way, they've also put another level in there, which if you have a total super balance above 10 million, then the earnings above 10 million will also attract an additional 10% tax. All right. Now,
Okay, so
David, do you want to, you talk about this one?
yep. So now that's in general the tax, but the reality is there's not a one universal strategy that one size fits all. So there's been a lot of media attention, a lot of sort of what to do in this scenario, for those impacted. It is really going to come down to your overall wealth and tax position. So just because you've got a tax for 3 million of balance above $3 million, obviously if it comes down to your personal tax rate, stage of life, when you can even access superannuation. Obviously some people think about, should I take money out of super? Well, you have to have medical condition of release. And then also your broader wealth structure. So some of the things, point one is obviously you're going to have to keep an eye on your super balance. That's something to keep an eye on going forward. Depends on the growth trajectory of your super. what you should be doing and thinking about. And we'll talk about that a bit more in other slides. The stage of life, accumulation versus retirement. So accumulation being still working, can't access your super versus retirement where you can potentially access lump sums out of super. And then also your broader wealth structure at point three there is yes, okay, you might be taxed more in your super, but are you better off paying the tax in the super or taking that money out of your super fund if possible and paying and putting in your personal name? So it really comes down to your overall wealth and tax structure and tax position, not just in the super fund, but also in your personal name. And it's going to take an ongoing potential planning for this because it's not a one-off decision. It's an ongoing decision if you're going to be regularly impacted, depending on how your superannuation performs in any particular financial year and depending on your super balance. So
All right.
this gives a bit more detail, Luke, which you can explain about the tax rates.
Yeah, so really what this slide's talking about is if you've got a total super balance at the end of the financial year under $3 million, nothing's going to change for you guys. It's still an effective tax rate of 15% inside superannuation. So where it will change now is with the balances above $3 million. So it's not a fund balance above $3 million, it's a member balance above $3 million. So when your member balance is above that $3 million, that's when the Div 296 tax will kick in. And it's still your accumulation earnings are going to be 15% tax. Your pension, so the asset supporting the pension, the earnings on that is still an exemption, but it's just that proportion of fund earnings now above $3 million, which will attract that 15%, which moves in theory the effective tax rate for superannuation at 30%. And then also, if you have a member balance above that $10 million threshold, there's an additional calculation. So you've got earnings from sort of 3 million to the $10 million there at the 15%, then a further 10 on earnings generated on member balances above the $10 million threshold.
So that's a good summary that you've given there, Luke. So you'll see in the bold there the 15% tax rate for super in accumulation phase, above the 3 million, 30%, and then another 10% above the $10 million. So in effect, also just being aware of your own personal tax rate outside of super. So superannuation over above 3 million taxed at 30%, that still might be a good tax position for you, depending again on your overall wealth position. Still at 15% below the $3 million is still a very attractive tax rate in most circumstances. But again, it's going to come down to the individual, what tax rate you actually are paying in your personal name as well. Luke, obviously the big question was about unrealised tax on unrealised gains. So can you explain how the change has been applied in this instance?
Yes, David, this was the main controversial aspect, I suppose, from when it was originally announced that they're bringing in this new Div 296. Um, in the original announcement, it was sought to tax unrealized gains with no credit. So what that means is that any uplift in value of an asset was going to attract Div 296 tax, even though the asset had not been sold. So it was on an unrealized portion. Now, our tax system has never done that in its whole history. So it was going to be something new. And you can see that this caused a lot of people to start talking in the industry and back and forth. And that was the reason why it had taken so long before this Div 296 was given royal assent. So um, it was nice back in October 2025 to read the new changes, which said that the tax would apply only to realized earnings. So obviously, anything that was unrealized now was not going to attract this new Div 296 tax.
And that was a great outcome for people. So, how is the actual tax calculated, Luke? Can you explain that to us?
Yeah, I'll run through this slide. So I'll do a bit of reading off this slide. So, point one, determine total super balance. Yep. So what this is a calculation of your total super balance across all your funds. So if you fall into that threshold of a total super balance above $3 million, you're going to be in the Div 296 area. Point two, calculate relevant portion. Yep. So that is when you have that, what we already spoke about previously is that the earnings above $3 million and earnings above $10 million, we need to calculate that to determine what the liability will be. From point number three. Yep, so that's a good point. Point number three. So what that's saying inside there is that um, if you've got a member balance above $3 million at the end of 30 June 2027, you're going to be in the Div 296 area. Um, so when we kick over to 1 July 2026, at that point in time, even if your member balance is above $3 million, you've still got time if the Div 296 was a strategy that you want to work towards. Um, you've still got time at the end of the year to bring your member balance below the $3 million, but this is the only year that that happens. So moving to point four of that slide, what it says that at the start of the financial year, if your member balance is above $3 million, and then at the end of the financial year, that current financial year, you've managed to reduce that member balance below $3 million, you're still going to have a Div 296 liability in that year. Because it's captured either at the start or the end. And then point five on that slide, which is what we spoke about, 15% and then 10% proportion of earnings above $10 million.
So that's a really good point that you made there, Luke. The two timeframes, which we'll talk a bit more about in a moment. But essentially, you've got some time to make adjustments in the next financial year. But from 27, 28 financial year and thereafter, they're going to calculate it based on your whatever's the highest balance on either the start of the financial year or the end of the financial year, whatever is the higher member balance. And I should explain when we talk about member balance, that's just because if you have a self-managed super fund, say for example, and it's $3 million in the self-managed super fund, but half is one spouse and half is another spouse, they're not actually impacted by Division 296. It would be if one's a $6 million super fund and both spouses had at least $3 million each. So it's not per super fund 3 million, it's per member of the super fund 3 million. Does it apply across super and pension? So you can jump in here, Luke, if you need to explain anything further, but there's the two main parts of your superannuation are either accumulation, essentially you're working and you can't access your money in superannuation, or retirement accounts. So that's with pension accounts. So you actually retired and you're converting your super to a pension. Currently, that pension limits in this financial year is $2 million. So $2 million converted to a super pension, tax-free, pays you an income tax-free in retirement now. Whether it's accumulation or pension or a combination of both, you're going to be impacted still by Division 296. It's not just one or the other, it's the whole total super balance. So your accumulation account and your pension account counts towards the calculation for Division 296. Was there anything else that you wanted to add on top of that, Luke?
Yeah, I think I might jump in, David. That was good. So yes, that's correct. It's on the total super balance. What you don't have in your slides at the moment is I thought I might give you a little practical example on when we start talking dollar figures on how the Div 296 tax liability will apply, and is sort of calculated. So for example, if you've got a total super balance of $4 million at the end of the financial year, say it's we use it when it first comes in 30 June 2027. So your member balances are 4 million. So that means you're brought inside a Div 296 calculation. Then we got to look at the earnings. So I've been talking about earnings a lot here. So the earnings above the $3 million dollars in this case, just for argument's sake, let's say it's $100,000. So if you're in, so for a calculation on that scenario is that that's going to bring to you to the member a Div 296 tax of about $3,750. So we jump a little bit forward and say you've got a member balance of $12 million dollars at the end of the end of 30 June 2027 with earnings of $500,000. So in that scenario, the Div 296 tax liability will be 64,585. So you can see the difference of someone with a member balance of 4,000,000, $100,000 of earnings, $3,750 tax liability versus someone with a $12 million, $500,000 of earnings, 64,585.
Okay, fantastic. Well, not fantastic having to pay additional tax, but thanks for the explanation. Okay, so I'll talk about this one because it's a strategic decision about is it best to withdraw funds above the $3 million? Well, there's no automatic right answer, as I keep alluding to. It is going to this tax is going to vary quite significantly from person to person. What's the best strategy to adopt? But firstly, before you take any money out of super, you have to make sure you meet a condition of release. So if you're under age 60, generally you're not going to be meeting a condition of release to be able to take money out. If you're over age 60, your potential of meeting a condition of release, and it may be worthwhile thinking about withdrawing above the $3 million, or it may not be. So potential case for withdrawing from the super balance above $3 million will reduce your Division 296 tax, which obviously is why you do that in the first place, and simplifies your tax position going forward. But then potential case for staying within the super fund is if your funds moved out of super, it may attract a higher personal tax rate. So super may still be more tax effective overall. So even though this additional tax is coming in, you just don't want to make a change just to avoid the Division 296 tax because, again, you need to factor in what's your personal tax rate. For someone that had predominantly, just say, with simple terms, someone with $3 million in super and retired and can access their money in super and have very little financial assets outside of superannuation other than their house, say a little bit of money in the bank, and that's about it. Well, you're probably going to be best off withdrawing some money out of super to bring you back below the $3 million. But if you had significant amounts of wealth outside of super and a tax rate at least above 30%, then you're going to be better off staying within super and just potentially paying the Division 296 tax. So it's going to come down to your overall tax position, which we keep reiterating. But I think the knee-jerk reaction from what I've heard out there from a lot of people is I'll just take my money out of super. But you have to think about that before you do that. Reason being is anyone that's got a super balance of $3 million or above has really got not much opportunity to put any money back into super either. So if you take it out, you're probably going to have pretty limited ability of getting it back in because you're over the a lot of the caps for, or total super balance cap for putting money back into super. Can you avoid Division 296 tax while still working? Well, again, there are some options you may want to think about. And we've already alluded to this already, but essentially the Division 296 tax does apply based on whatever you from the not the first financial year, the 26-27 financial year, but the 27-28 financial year. Whatever the higher balance is at the start of the financial year or the end of the financial year, that will be what is applied. So essentially, even if you get it below the thresholds in that financial year, if at the start of the financial year it's still above $3 million, well, you're going to still cop that tax, even if you are reducing your member balance in some way, shape, or form. But some of the things you may want to think about Number one is your contribution strategy. So obviously we've got the contribution caps. Um, Essentially, if you're going to put more money into super and it's going to get you closer to that $3 million threshold or above, you may want to think about potentially not putting money into super. Or putting in, if you go point two, consider spouse contribution splitting. So you can, a few different ways. You can, if you all got a higher super balance and your husband or wife has a lower super balance, again, you may want to put super into their super balance rather than your super balance. Alternatively, again, you can do what's called contribution splitting. So up to 85% of whatever you put in as a concessional contribution in the financial year, which is up to $30,000, can, after the financial year, be split across to a spouse. So again, they're just different ways of, ideally, you don't want one spouse at $3 million and another spouse at, say, $500,000, and try to balance up the superannuation balances to keep you both under that $3 million threshold. Because if you've got a spouse, particularly well below the $3 million limit and also well below the $2 million limit, you can still have the $2 million in super tax free. So we still got that tax incentive up to that $2 million limit. It's just not as attractive going forward for the larger balances above 3 million and then above the $10 million. And then number three is, it doesn't stop you from further investing, but it's just whether you need to develop a strategy for you personally of accumulating wealth in a tax effective way outside of super. And that's where we work with clients to overall look at their strategy, not just purely investments, but the structuring of their investments to make sure it's as tax effective as possible. So, Luke, you'll get tax notices, no doubt, for clients when this starts coming in from the tax office. How will this actually be paid?
Yes, so for those familiar with the Div 293 sort of structure, the Div 296 is going to sort of mirror that. So it is a tax that can be paid personally, or also can be a tax that you can pay from superannuation in theory. So um, paying once you get the notice from the ATO, you can pay that personally. That's pretty straightforward. If you're wanting to release from superannuation, then what you would need to do is you need to make an election with the ATO to release. Your accountant can assist you with that. And then also, once the election to release has been made, you will get what's called a commutation sort of authority or a release authority from the ATO, which therefore that'll come under the superstream environment. And then you can make the well, that then that when getting that from the ATO allows the fund to make the release.
All right. What if I receive my spouse's super upon death? So, and it's something that I've reading a few different strategies about and different things to think about as part of this new tax. So, if you inherit your super from a spouse and your total super balance increases and say it pushes you above the $3 million, what is the key implications there? Well, the key implication being Division 296 may apply for that surviving spouse going forward if the combined balance pushes them above the $3 million or again the $10 million for that matter. So there's no special exemption for inherited super. So it's something to just be aware of that you may again have two spouses $2 million in super each, don't pay Division 296 tax because they're both below the $3 million. But then all of a sudden, if they inherit $2 million from their spouse as super, $4 million in super, then all of a sudden they are captured by Division 296. So what to consider, estate planning, succession planning becomes increasingly important for couples with large combined super balances. So again, it's not just avoiding Division 296 and how do you manage that now, but that also is an estate planning implication which you should be aware of. Is there anything additional that you'd want to add to that, Luke, at all?
No, no, I think that's very good, David. So yeah, it is a it is a planning strategy. I know you can't plan for death, but once death is there, really just be aware there is some strategies that David and myself can look at.
Sorry. Thank
That's
you.
all right.
All
Um,
right. So some key dates to be aware of. So um, obviously coming around pretty quickly is the 1st of July 2026. So basically what's going to happen is that is the start of potentially a Division 296 liability in that financial year. So you've got between the 1st of July 2026 then to the 30th of June 2027 to essentially get your affairs in order if you're wanting to avoid the Division 296 tax or get advice regarding what best to do in your situation. Reason being, as Luke already alluded to, if your super balance is below the 30th of June, below $3 million dollars on the 30th of June 2027 in the first financial year only, then you're not assessed for Division 296, but you will be from the 2027-28 financial year onwards, and the ATO will start from that essentially financial year issuing assessments. Anything there from a practical point of view, Luke, and the ATO reporting and administration that we need to be aware of?
no, nothing new. I think we covered most things on previous slides, but yeah. So the key point is keep an eye on 30 June 2027 date.
Yeah, absolutely. So you don't need to panic just yet if you're worried about this, but you will need to eventually take action if you can do, obviously subject to being able to withdraw money from super. What should SMSF clients be aware of? So there is a slight difference between Division 296 being applied for self-managed super funds and the legislation as opposed to an APRA regulated super fund. I might get Luke to chime in a minute here, but before I do that, I'll just try to explain as best I can action that can be taken before the 30th of June 2026. You will see there that exclamation mark in red. SMSFs do have an opportunity, and it's unique to SMSF to reset cost bases for the fund's investments. So if you wish to, you can elect to reset cost bases to avoid or for CGT purposes in the calculation of Division 296. Um, and you elect that before lodging your 2026 SMSF tax returns. But you can't pick and choose which investments that you want to reset the cost base for Division 296 purposes. It's either all of the fund or none of the fund. So you're going to really have to have your own um, portfolio, own self-managed super fund reviewed on what's going to be the best option for you. I think in particular, you're going to have to think about any SMSF that has property assets is probably definitely worth getting some advice from the tax accountant and reviewing that. Before we jump into those other points there, Luke, and going over those, if there's anything you wanted to add to resetting potentially of cost bases.
Yeah, this one is I suppose a case by case, client by client sort of scenario where we need to look at what we're resetting because different. I don't know if some were remembering back in 2027 when we could do a cost base uplift back in 2027, we could do it on um, individual assets. But as David had said here, with the Div 296, if the election is made to do a CGT uplift or a cost base uplift, then you're doing it on the whole, all the assets inside your fund. So you need to really look at um, do you have capital losses in there that you're thinking that you want to use for tax purposes? Um, do you have assets? So when David was talking about the cost base uplift, it only applies for Div 296 calculation. It doesn't apply for capital gains tax calculations. So It really is a planning strategy there.
Yeah, and that's just to be 100% clear. It doesn't avoid capital gains tax on super, but it's just resetting for the Division 296 tax purposes because realised gains can be captured as part of the earnings for Division 296 tax. We'll just go through these points, points 1 to 4, because again, they're a bit unique to SMSFs, but something to really be aware of. Asset valuations. So when it comes to an SMSF, particularly again, this will be a property related, it will be the main super fund we need to be aware of is they will be scrutinizing and looking very closely at how the fund is valuing property. So obviously, if you're trying to value a property for SMSF purposes that avoids the Division 296 tax, well, they're going to be looking at that very closely, and auditors will be required to look at that very closely as well. So you're going to have to be giving as best as you can market value for all your assets and all your investments in your self-managed super funds to avoid further scrutiny. Number 2 is, and this isn't just an SMSF strategy, but a broader super fund strategy, you are going to, particularly if you're taking the Division 296 out of your super fund, is having liquidity planning and making sure there's money there to pay the additional tax. So it means that obviously having assets there that, well, cash, liquid assets, well, whatever it looks like for yourself, but ability to be able to pay the liability. And it could vary quite significantly year on year what the actual tax is. Just because, it depends, unless you know exactly what your super funds are going to perform, the say realized gains, and what that all looks like on your super fund, it could be quite different. And so just being aware of the liquidity needs of your super fund. Point 3, record keeping also sort of dovetails into what I said with the asset valuation, is just making sure your records and earnings and documentation is up to speed and that you're giving true and proper valuations, true and proper earnings, and that's clear exactly what it is that the super fund actually earned. And then investment strategy review. You should be doing this anyway, despite Division 296, but this just highlights the need to continuing to monitor the investment strategy for your super fund, and is it still appropriate for you, and are there any changes that need to be made in light of Division 296. One real practical example for a self-managed super fund, if you've got predominantly your super in one property, which I know the tax office is looking at that anyway in closer scrutiny. But if you don't have liquid assets and you need to have a Division 296 bill and you can't pay it personally, which you can elect to do, but if you wanted to pay that out of the super fund and there's no money there to pay it, well, obviously you're getting yourself a little bit caught and stuck in how you actually pay Division 296. So you're going to have either personally the ability to pay Division 296 or set up your super fund with the ability to be able to pay Division 296 if you are impacted by that. Sorry, before I go back, was there anything there that you wanted to add in, Luke?
No, that's well covered, I suppose. Yeah, really the honing in on point number 1, asset valuations. It is an area from experience that a lot of auditors uh, sort of pay particular attention to around property and making sure you've got evidence to back up your valuation. So that's something that's going to be very important. Well, it is very important, but it will continue to be important.
Yeah, everything should really be market valuations as accurately as possible for super. What impact does this have on my investment strategy? Well, sort of alluded to this a little bit already, that, you do need to think about liquidity in your fund, Division 296 liability, how are you actually going to fund any additional taxes? And then talk about asset location, relatively tax position inside and outside of super. There are some, different things you have maybe income producing investments outside of super, if that makes sense. Maybe less income producing investments inside of your super. But it's going to really come down to your individual investment strategy, what investments you're wanting to hold long term. Um, we obviously want to minimize tax as much as possible, but you don't want to be solely making investment decisions as well based on tax. But obviously, we want to try to make sure that we're minimizing it as much as possible in your overall wealth position. So again, it may be that what superannuation investing in superannuation wasn't as attractive as it once was, but it still might be more attractive than investing in your own name. Or again, if you don't have much invested in your own name personally, it might be worthwhile to potentially start investing some money in personal name or some other vehicle. So, whether that's a family trust, whether that's investment bond, whether that's just in a lower income spouse's name, these are all options that are worth considering in their overall position. Realized gains matter. So tax outcomes will be influenced by the taxable investment outcome and realized capital gains. So realized gains are assessed. Unrealized gains aren't. So that was the significant change. But yeah, essentially timing of realizing gains in your super fund that will add you to Division 296. But yeah, in terms of you know, how you manage that will come down to an individual basis on when selling investments, particularly if you've got large assets in your self-managed super fund with large gains. That's again why you may want to consider resetting your cost base if you're a self-managed super fund client. But yeah, overall, you do need to factor in that realised gains will be captured by Division 296 if you're in that level of 3 mil and above. Anything from your perspective, Luke, to add to that?
No, that's well covered there, David.
Thank you. All right, so Division 296, we're getting near the end of our presentation. It comes down to right approach is going to be the integrated broader wealth strategy. It's not a set and forget decision. And even if we get you below $3 million initially, you've got to, this is something that's going to be managed and have to be managed on an ongoing basis for those that are, near that threshold, or maybe not now, but, if you're a wealth accumulator, in your 40s or 50s, still got a significant super balance, and growing, then, you might not have a Division 296 tax problem yet, but you need to be aware of this, that it will be something that you need to think about in the years ahead and how your overall broader wealth creation strategy looks like for eventual retirement. But, you need to keep an eye on your total super balance, projected growth of your super fund, consider the broader wealth position inside and outside of super. If you have an SMSF, make sure your valuations are properly done and up to date and accurate. Liquidity for a self-managed super fund is important, but also your own non-super fund, self-managed super fund supers, and avoid decisions without getting personalized, integrated advice of your overall strategy. And that's where myself works very closely with Luke, and Luke works very closely with myself in making sure that if it's Division 296 or just any sort of tax and superannuation and investment planning, strategy advice and retirement advice is done correctly. We work very closely. Luke will answer often the tax questions that I don't know the answers to, and then I'll chime in with the investment and retirement planning advice that is required for clients as well. But it's going to really be a strategic approach per individual. So that comes to essentially a conclusion of our presentation. Looks like we've got at least one question in the chat group there. It has asked about should we be updating our beneficiary nominations in light of Division 296. The short answer is it could be, but again, that's going to really depend on your overall estate planning, succession planning um, needs. So essentially, there's a couple of options that you do have when nominating. I'm assuming you're someone retired here at the moment, older in life. A binding nomination or non-binding nomination is essentially if you have a nomination like that, it's paying out of super generally to the surviving spouse or adult children. But if you have a reversionary beneficiary where the reversionary pensioner, so you've set it up, a superannuation pension is reverting to the surviving spouse, it actually goes from, stays in super, but goes to the spouse and added to their super. That's particularly where they may be impacted by Division 296 tax if they're inheriting the other spouse's super. So again, there's been a bit of talk and commentary around do you have a reversionary beneficiary or not on super? It's something to at least worth looking at with some people, with your financial advisor, accountant, people like Luke and myself. But yeah, essentially, it's again, it's worth looking at, but it can't say yes or no what's going to be the right answer um, for you without reviewing your overall position. Was there anything about beneficiaries at all, Luke, um, that you can add?
Um, I suppose, yeah, what you sort of spoke about there is that it's time to consider whether a reversionary beneficiaries is the way to go. And everyone's going to have, it's a different for everyone. So I think it's time to sort of sit down with your advisor, and look at, do I need to make changes to my original pensions, and say that, well, maybe if I'm concerned about Div 296 tax, do I want that to revert on my death, uh, obviously to my spouse?
Yeah. Again, we did have that slide earlier that said if you say $2 million, the spouse has $2 million and another spouse has $2 million and they inherit the other spouse's superannuation, um, they put something to the $4 million super. So again, they would be Division 296 tax on that. But if there's a couple and they've got $2 million each in their super, they're not impacted by Division 296. So that's where what we're talking about is worthwhile reviewing your nominations and whether it's still appropriate or not. Again, depends on assets outside of the super and your overall wealth position as a couple, not just isolated to super. All right, well, that wraps it up. Thank you, Luke, for joining us today. So, Luke, as I said, is an SMSF accountant with Patrick Rowan Associates. He's director there, been very experienced and really an expert in superannuation tax. I'm the senior financial advisor. We're here. I'll just go on to the next slide because it's got our details there. So, there's a phone number there, an email address. I can put you into contact with Luke or myself, or if you call through or email us and we can assist, or we've got other, advisors within the APT network that can assist you as well. But essentially, it is worth reviewing Division 296 and the impact on you personally. If you're impacted already or think you're going to soon be impacted, or in the years to come, you need to be aware of that if you've got a growing super balance. So, yeah, we're here to help. And there is a timeline there that, we can assist clients potentially avoid it if it makes sense before the 30th of June 2027. So there is sort of a time frame to it, but it does come into effect in the near term, being basically the start of next financial year. So yeah, not it's something that to take action on and reach out if you have concerns. Thank you and enjoy the rest of your